Private placements and capital market issuance of debt. Debt can be raised either through private placements or through public capital market issuance. A private placement involves selling debt securities directly to a small number of institutional investors, such as pension funds, insurance companies, or banks. These transactions are typically negotiated privately and involve fewer regulatory requirements compared with public offerings. As a result, private placements can often be completed more quickly and with lower disclosure obligations. They are particularly attractive for companies that prefer confidentiality or require flexible financing arrangements. However, interest rates may be slightly higher due to the limited investor base and reduced liquidity of the securities that, in contrast, capital market issuance involves selling debt securities, such as corporate bonds, to a broad group of investors through public markets. This approach allows companies to raise substantial amounts of finance and access a diverse investor base. Public debt issuance typically requires compliance with strict regulatory and disclosure requirements, including credit ratings, prospectuses, and ongoing reporting obligations. Although the issuance process can be complex and costly, public debt markets often offer lower interest rates because of greater liquidity and investor competition. Large corporations frequently rely on bond markets as a major source of long-term financing. When deciding between private placements and public debt issuance, organizations consider factors such as cost, speed, confidentiality, and market conditions. Private placements may be preferred when firms require tailored financing structures or wish to avoid extensive regulatory procedures. Conversely, public issuance may be advantageous when raising large sums of capital or establishing a market presence among global investors. Companies also evaluate their credit rating, investor demand, and timing of issuance. By selecting the most appropriate financing channel, financial managers can minimize borrowing costs while ensuring reliable access to long-term capital.